Hello everyone, welcome back. I got some really good ones for you this evening, but first I hope you've been having an awesome week so far, and if not, hey, just hang in there, keep going. You're not alone, things will get better. Let's dive right into it, shall we? Markets. The three major US stock indices moving up quite nicely since my last video about 10 days ago. Seen a lot of strength in these risk assets like the NASDAQ, oil, even cryptos are trying to maybe carve out a bottom here. What's going on? Well, we've talked a lot in these videos about instability in credit markets globally and kind of Fed policy. Well, we're seeing a little bit of stability in debt markets globally. We've had the 10-year yield come down today from, it came down about 13 basis points today to like 4.07% on the 10-year, which is a substantial move lower. And when those bond yields move lower, drags down the dollar, those interest rates kind of stokes inflation and gives asset prices a little bit of room to, breathe a sigh of relief and kind of reinflate themselves. So you've been seeing all year how Fed policy, Fed interest rate hikes and higher bond yields have, created enough instability to kind of crush a lot of risk assets. And this is in an attempt to bring down inflation. You've been seeing that. However, over the last few trading days, rumors have started to fly that potentially we could be looking at a Fed flip as early as December. So if the Fed starts to flip a lot more hawkish going forward, or at least tones down their hawkish rhetoric, these 75 basis point hikes at every meeting kind of thing, and becomes a little bit more dovish, it should continue to allow some of these risk assets to recoup, a lot of their losses for the year. I do think that seasonally fall and Christmas, December end of year, pretty good for risk asset prices, whether it be precious metals, cryptos, stocks. They all generally tend to do well in October, November, December. And I think the Fed kind of wants to set the markets up for that because the markets have been just beaten up so much over the last, year or so. So we're seeing bond yields fall, interest rates fall, dollar fall, mortgage rates fall. And when all those things fall, it's the perfect setup for risk assets like NASDAQ, oil, Bitcoin, and gold to move up. And you're kind of seeing that inverse relationship at play. That 10-year yield got very, very high, very ahead of itself, kind of had a fear trade going on, a lot of dollar strength in relative terms, and it brought down those risk assets. Now we're kind of seeing a reversal of that. So, hey, we'll see if markets roll back over or if this holds. I'm tentatively bullish risk assets only because I think the Fed has kind of overdone it on a lot of their hawkish rhetoric over the year, and I'm waiting for them to kind of tone that down. And these very forward-looking markets are just waiting for that Fed flip and want every excuse to inflate on that. So kind of seeing that. Last couple of videos, we've also talked about instability in the UK debt market as the Bank of England stepped in and bought British gilts. It drove those gilt yields down, and we also saw yields in bonds in the United States come down as well. These markets are totally connected, okay? So if you don't think the Fed and the Bank of England and like the ECB and the Bank of Japan are all working very closely, you're missing it. They're totally in cahoots. They're totally in bed with each other, calling each other all the time. Yo, are you gonna ease? I'm gonna tighten. Are you about to tighten? Maybe I should ease. So whenever stability was brought to the UK debt market, it also kind of brought stability to the US debt market, pushing those bond yields down, allowing things to really reinflate, kind of like a targeted, very pointed attempt at quantitative easing. So these central banks are getting really creative and specific in sectors of the economy that they can support, and you're kind of seeing that. So yeah, a little bit of stability in debt markets globally, a little bit of weakness in the dollar, kind of putting upward pressure on everything else, like out to the end of the risk curve. You're seeing it. What else is going on? We got some geopolitical tensions. We had the Nord Stream 1 and 2 pipeline get blown up a few weeks ago by somebody. The media silence out of the West is deafening. but I, can't really speculate on who did that. Somebody knows, okay? Somebody has the report on the size of the blast, the depth of that crater, how much of the pipeline was destroyed, exactly where, who probably did it, what kind of munition did it. Somebody knows, but, the fog of war is real. Additionally, we have Russia coming out and trying to say that Ukraine is planning to set off a dirty bomb in one of their own cities in an effort to create a false flag event in order to justify NATO moving in and really reinforcing Ukraine and allowing NATO to go toe-to-toe with Russia, as opposed to just, Ukraine versus Russia with NATO's support. We have the 101st Airborne Division starting to bolster up Eastern Europe. So I think that's, going to be kind of a friction point and a hot spot for the next few years. I would imagine the US dollar empire is going to pump a lot of inflation into Eastern Europe. All of these missiles that Ukraine are firing at Russia are also not bought and paid for and donated. They're loans. So as the US kind of weakens their own currency, well, they also export a lot of that inflation to Eastern Europe. And you might be thinking that's a waste of money, but it kind of does. I'm not making a moral judgment here, but fiat monetary systems, especially the world reserve currency, whether it be the pound sterling, 100 or so years ago, or the United States as of the last 100 years or so, whoever's the world reserve currency kind of has a monopoly on force, and that's ultimately what the currency is backed by, the ability to levy taxation and enforce it, the ability to force other countries to transact in your currency, the ability to make your currency stronger by having a monopoly on the use of physical force. Put it like this. If we were on a gold standard or a Bitcoin standard, we wouldn't be playing the game of Monopoly that we really are playing in real life. The way I look at it, imagine like in the backyard, there's like a guy, in this backyard, there's like a guy trading somebody some gold coins for some blueberries or whatever. People are just kind of bartering, sending Bitcoin to each other for this, that, or the other. They're not sitting at the Monopoly table that the fiat Ponzi wants them to sit at. They need to go play Monopoly. And what is the game of Monopoly denominated in? The little Monopoly dollars. And that's the world reserve currency. So to keep everyone sitting at the Monopoly table and playing the board game, rolling the dice, going around, buying Park Ave, landing on Park Ave, passing go, that's kind of the game that these fiat empires and especially world reserve currency, big boys want you to play. They want you playing their board game at their table. And how do you kind of keep that currency valuable and keep that whole game everyone's playing valuable? You have a monopoly on the use of physical force. So you allow people to only play this game in your currency. And if people are off, using Bitcoin or gold, and you're not able to track those transactions or tax those people for their income, those people are really renegade, and they're not playing the game of Monopoly in real life that these fiat global monetary systems want you playing. So I think there's a big game of Monopoly going on. It involves a lot of death and destruction as well. But the dollar empire kind of requires perpetual violence in order to keep its fiat monetary system relevant and on top and dominant. And not only that, but I think you can't have, it gets worse than what I just said. Not only that, but you can't have perpetual war without a fiat monetary system. So I'll say that again. If you have a gold-backed currency or a Bitcoin-backed global currency, I would say wars would happen half as often or less, and they would be very short. Would you rather fight a war with your gold coins and your Bitcoin, or would you rather fight a war with fiat money, and then the more you do with that money to fund your wars, the more powerful that money becomes? You see how if you have a fiat monetary system, you need perpetual violence and perpetual war. Whoever you are, I'm not picking on America, okay? It could be whoever the world reserve currency is. If it becomes the yuan or the ruble or which, I'm not saying that'd be good, or it becomes the pound or the whatever, whoever that country is, they're going to need to be the one that's doing perpetual war, monopoly on the use of physical force, perpetual violence in order to keep their global monetary game of monopoly running smoothly. It's kind of a weird perspective I just gave you, but can you see how if me and you went to war with one another, if we were forced to pay for the war and the court fees or whatever in gold coins, we would get, or our Bitcoin or our stocks, or our homes, we would get burnt out a lot quicker than if we had a machine that just printed money, and the more money we printed, the more we could fight this war. That's kind of what I'm trying to get at. But anyway, geopolitical tensions aren't really improving. Concerning Bitcoin's world peace, all right? If everybody's, if we have a completely decentralized monetary network, going to war wouldn't be nearly as profitable. Having a monopoly on the use of physical force wouldn't be nearly as much of an objective to pursue as it does when you're in a fiat monetary system. So, that euro-dollar system kind of feeds on perpetual war, and I hate that Ukraine and Russia have to be a part of that. But I also understand that whoever the world reserve currency status is, Great Britain, whoever, look at their history of violence. If you're the world reserve currency, you're also very violent because you need to force all the players at the global stage to play your game of Monopoly and not go out into the backyard and secretly transact in Bitcoin and gold. So they're just my thoughts on there. A lot of dollar loans going to Eastern Europe, all due back with interest, by the way, which creates immense demand for dollars. And we're just going to have to see. But horrible business. Thoughts and prayers to everybody concerned on both sides. I don't like violence and war. It's obviously. Moving on. What else is going on? Earnings week. So look at those big tech names, Facebook, Amazon, Apple, Netflix, Google, the FANGs, essentially Microsoft. We got a lot of earnings coming this week. However, these markets aren't really trading on earnings. The NASDAQ, the tech-heavy NASDAQ, is very interest rate sensitive, and it's more trading on what's happening in debt markets and Fed policy than earnings. I think the street has an expectations that earnings probably aren't going to be too horrible or good, and so we're just going to kind of get through it. See what happens. I do worry about Meta. Not a buy or sell recommendation. We don't do that on this channel ever. But one thing on Meta, the metaverse is really hemorrhaging. Okay, Mark Zuckerberg's trying to just create legs for avatars, and that's coming with like a $10 billion price tag, and that technology's already existed for like a decade. Crazy misallocations of capital going on in Meta. They really need to trim the fat, get rid of a ton of employees, and figure out if the metaverse really is the future. I did a video a few months ago, is the metaverse, don't let the metaverse drink your milkshake. I do kind of stand behind some of those statements I made. However, the metaverse ain't drinking anyone's milkshake right now. I think Decentraland has some like 300 active daily users or something, paltry numbers coming out of the metaverse. So, kind of avoid Meta like the plague, but I like Amazon. I'm constructive on that. I like Apple. I'm constructive on that. These aren't buyer seller recommendations, but I like the companies, where they're at, what they're up to. They're going to remain dominant players in the space. Google, okay. So Google, Amazon, and Apple, I really like. Netflix, not so much, and Meta, not so much. I'm a real Netflix hater, though, but for no real reason. That one just kind of slipped past me, and I was just a hater while it made a bunch of people rich. So try not to let that happen next time a very constructive technology comes out and totally breaks the game. You want disruptive technologies that are going to change up the game. The game that we play is not rigid. It's not as rigid at all as all these gold and silver bugs want it to be economically, or Austrians want it to be economically. It's a complex adaptive system, and when Netflix came onto the scene, it really ate everybody's lunch. So I'm a Netflix hater, but I have no excuse for it. kind of a little tangent on your FANG. So look at earnings for the mega cap tech stocks, okay? But again, keep in the back of your mind that markets aren't really so concerned about earnings. They're much more concerned about just how hawkish or dovish the Fed's going to be acting over the next 3 months, and just how much stability we're going to see in credit markets over the next few months, and how much stability we're going to see geopolitically over the next few months. I think the markets really are not ready to react to uncertainty in Ukraine really ramping up. So just kind of be ready for that. Like, I think a lot of the hawkishness even for the year and Fed expectations are baked into the market, but I'm not really convinced that, a dirty bomb or violence or unforeseen events in this war with Ukraine and Russia, I don't think those are being really fully priced in by the market. So expect, if a false flag does happen, or God forbid it, a dam or a dirty bomb blows up, something catastrophic happens, expect markets to react accordingly. I think that would create a lot of asymmetrical, a lot of basically expectations that aren't being baked into the market right now, manifesting in a very short period of time and creating a lot of volatility. So keep an eye on the geopolitical tensions, keep an eye on those tech earnings, kind of ponder how a fiat monetary system requires perpetual war, and how perpetual war is only possible with a fiat monetary system. And keep an eye on those bond yields, interest rates, and the dollar. And as those three things come down, expect risk assets like NASDAQ, oil, Bitcoin, and gold to do the opposite and go up. One more thing, and then I'm going to let you go. I do believe the Fed raising interest rates puts downward pressure on risk assets. I do believe this. And I've seen so many examples throughout my trading and escapades to know that when interest rates are rising aggressively, that puts a lot of downward pressure on risk assets, and it sucks a lot of liquidity out of markets and puts them in fixed income and debt markets. I'm very aware of that. However, I'm kind of questioning to what degree it affects inflation. I would say a common assumption that's built into most market participants' internal model and their paradigm is this idea that when interest rates go up, it brings down prices of everything. But I'm here to theorize with you, and leave a comment if you think I could be onto something, that although raising interest rates does force markets and risk assets to deflate in value, it doesn't necessarily make consumer prices like shoes you buy, or cereal and milk, or it doesn't really make inflation and those things fall when you raise interest rates. And this is why. I'm going to run this past you, because logically it doesn't make sense. Like, I own a couple businesses, all right? But let's say, for the sake of example, I want to start a donut shop, like in a couple months from now. I just want to do a donut shop. I'm going to need to borrow, let's call it $100,000. Well, if the interest rate was really low, which it was just a few years ago, I could borrow very cheaply and not really have to pass the cost of that financing off onto my customers. So I could actually keep donut prices pretty low. And not only that, but if interest rates were low and the cost of borrowing was very low, we could have a lot of people opening a donut shop in the next few months. And now you have a ton of firms in the space, all with very low borrowing costs. So they don't really need to charge that much for their donuts. But now that we're in a situation where interest rates are going up, instead of donut prices going down, they might stay elevated or move up more. Because if I want to open a donut shop now and I borrow $100,000, that interest rate's going to be a lot higher. So over the course of that loan, I'm going to have to shell out a lot more money just to service my debt. And if I'm going to have to service a lot of debt and high interest rates, I'm going to need to pass those costs off on the customer. So I'm going to charge more for donuts. And with interest rates going up, in this example, there's probably a lot of other people that would like to open a donut shop, but they can't afford the financing. And so there will be less players in the space selling donuts at higher interest rates, which is inflationary because there's less competition. And your borrowing costs, because interest rates have gone up, need to get passed off onto your customers, so you're gonna have to raise donut prices. So I think that the Fed raising interest rates makes NASDAQ, oil, Bitcoin, and gold prices go down, like asset prices, real estate prices go down because mortgage rates go up a lot. But I think other things like your shoe, a widget, a fishing lure, those don't necessarily deflate as much as the Fed wants them to by raising interest rates, because the the cost of that capital gets passed up. It just gets reflected in the price of those goods and services. So what I'm getting at is all year Fed's been raising interest rates. Higher interest rates has really hurt, the stock market, asset prices, real estate, Bitcoin, oil, gold, squishmallows, whatever. But I don't think raising interest rates is going to put a lot of downward pressure on consumer prices, because those higher borrowing costs are just going to be passed off on the customer. So markets hate high interest rates and deflate on that, but I'm not convinced that the real economy, the price of a shovel or a video game console, I don't think those are going to come down too much, in as much as the Fed would like to see them come down in price, because again, those small businesses are just borrowing money at a higher cost, and they need to pass those costs off on to their customers. So higher interest rates cull risk assets, but I'm not convinced it's going to be very adequate at culling inflation. Probably a little bit, but not as much as the Fed thinks. Just my thoughts, though. That's just kind of me theorizing. I've been thinking about that. Tell me what you guys think. I think higher interest rates makes donuts and coffee go up, but I don't think higher interest rates makes Bitcoin and the S&P 500 go up. Kind of weird, but complex. The financial system and the real economy are not the same thing. So all things just to chew on. Keep an eye on those bond yields, interest rates, and dollar. Keep an eye on that Fed rhetoric. Keep an eye on those market expectations, geopolitical events, and tech earnings. That's really all I got for right now. And think about, if you were to start a landscaping business tomorrow, what your borrowing costs would be with these higher interest rates, and whether or not that would force you to lower your prices or want to up them. That's all I got for you today. You're awesome. Like, subscribe, share, whatever. We'll keep going. Thanks for listening. Till next time.